Hey everybody, welcome back to Dividend Stockpile, the channel where we talk about all things dividend income investing related. Today we have a very special guest, Joe Becker, Director of Product Management with Innovator ETFs. And we're going to talk about one of their brand new ETFs, SPUT, the Innovator Equity Premium Income Daily PutWrite ETF. Now we've all seen or are invested in covered call ETFs, but this innovative ETF flips the script by focusing on the income generated from the daily sale of put options on the S&P 500, as well as the potential capital appreciation for the underlying holdings in the S&P 500. We're going to go to the details of this product and talk about all the great benefits. Before we do that, hey Joe, thanks for joining us.
Hey Jeremy, thanks for having me on. Good to be here.
Excellent. So I was very excited to get in touch with you and to have you on the channel because when I was researching, I found this great ETF that you guys just launched, SPUT, or SPUT, I guess is another way of saying it. And I found it so innovative that I wanted to get you on the channel to talk to the audience about, what differentiates this ETF from some of the other ETFs out there. Before we get into that part of it, can you introduce yourself and a little bit about your company?
Sure. Yeah. Again, my name is Joe Becker. I'm the Director of Product Management here at Innovator. Innovator is an ETF firm founded in 2017. We really came to market to bring what are known as defined outcome ETFs. That's been a rapidly growing category of late that's been in the news. And we were the first to bring the buffer ETF to market. And so that's what we're known for. But in recent months and years, we've also been expanding into other areas like income. And so that's what we're here to talk about today.
Yeah, excellent. Yeah, the buffer ETF or the defined benefit ETFs are very popular right now. It seems like there's a new one coming out every week. So you guys say you were one of the first or the first to do that product?
We were the first. We launched the first buffer ETF in August of 2018. And really the interesting story behind that, Innovator was founded by two guys, co-founded, John Southard and Bruce Bond. They were the co-founders of PowerShares back in the day, which they sold to Invesco. And they were out of the business for a little while. And I think it was in 2016, maybe, John Southard was sold an instrument that offered a defined outcome. I think it was an insurance product or maybe a structured note. And he liked the outcome. He liked the payoff profile, but he asked himself, well, why couldn't this be done in an ETF? And that was the catalyst to sort of get this whole thing going. And so yeah, August 2018, we launched the first buffer ETF. We now have more than 100 ETFs with over $24 billion of assets, and the growth in the space, as you mentioned, has been rapid. A lot more competitors coming into the space. I think there's something like close to 300 defined outcome ETFs in the space now, and so investors just really like having that certainty, right? Knowing that you've got a known amount of upside with this built-in buffer to protect against downside losses over a known outcome period. It's simple and gives a lot of peace of mind to a lot of investors.
Yeah, and especially in the market that we're in right now, the volatility, every day you don't know if it's going to be up 2%, down 3%. You never know where it's going to go. So to have that benefit, but also be able to potentially make more capital appreciation than maybe a bond or a certificate of deposit, taking a little bit more risk, but still having a defined outcome is a great middle point, I think, for a lot of people. So it sounds like most of your, if not all your ETFs are actively managed, which is another field that's really increased in the last couple of years. So what are your thoughts about the future of active ETFs compared to the passive or index-based ones that we were used to before all these new innovations?
Yeah, it seems active does have a bright future ahead. There were some rule changes about 5 years ago that made it a little bit easier to issue and launch actively managed ETFs. And I think a lot of viewers, a lot of investors will think of actively managed as you have a portfolio manager who's picking a stock over another stock, right? They're making that kind of decision. The vast majority of our ETFs are rules based. So, right, for example, with the buffers, they're filed as actively managed ETFs, but they follow a rules-based process so that every period they're simply resetting that buffer level, resetting that upside potential. It's not like, oh, we like this stock better than this one or this option better than this one. It's rules-based. And that's how a lot of these actively managed ETFs operate. So yeah, I think the growth will continue there for sure. We've seen even just in the derivative income space over the last 5 years since that rule change, $100 billion has flowed into that space from a base of about $2 billion. So rapid growth that we've seen in the last 5 years. I think we're going to continue to see that.
Yeah, I love the fact that there's so many opportunities right now in ETFs. So we can rely on investment professionals to focus on the details of running the fund, but we still get to benefit from those enhanced strategies. When you look at your passive ETFs, they're usually pretty basic. You're just following an index or something. You don't really get that differentiated potential return or income focus or whatever it is your goal is. But with all these new active ETFs, there's something for everyone at this point. And you guys continue to innovate, continue to roll out new products, not just about Innovator ETFs, but across the investing landscape. So as a retail investor, it's great because you have so many options right now. But then again, you have to pick one. So sometimes too many is a bad thing, but it's also a good thing because we can really pinpoint our strategy and pinpoint our niche that we're looking for by using these active ETFs. And Innovator ETFs provides, as you said, over 100 different options of different types of ETFs that we can focus on. So a lot of people are a little turned off about the active ETFs because of the management fee. So we're going to talk about the details of this particular fund in a few minutes. But what benefit do they get, or what benefit do we get by paying the active fee over the passive indexes?
Mm-hmm. Yes. So really the benefit, if we think about passive, the biggest ETF, or maybe it was recently surpassed, but the big ETFs are the S&P 500 ETFs, right? And it's simply replicating the S&P 500 index. And that is good, cheap beta exposure for investors to have. But for investors who maybe don't want to take on that full risk, in the case of Innovator's buffer ETFs, we can go in and implement a process where we'll give you one-to-one exposure to that index, but we'll put in some guardrails, right? If maybe it's like, if you think of a bowling analogy, we're going to put the bumpers in the gutters and sort of let you guide you down the path to make sure you don't get off track. And so there's value in that. And just given the flows, we think that the price point on these is at a point where this market clears and clears efficiently. And so yeah, the flows have been strong, and we think the price point reflects an appropriate level given those flows.
Yeah, and I've been telling everyone that when I talk about different ETFs, a lot of people complain about the high fees, but you guys are the experts. You guys are providing a service that we wouldn't be able to do ourselves, or if we do, it's going to take a lot of our time and energy. So by paying 0.5% or 1% a year for you guys to actively manage and do all those details, it saves a lot of time for us. So I'm in the camp where as long as the return and the focus area is meeting my expectations, the fee is worth the money. So I always tell people, look at the total return, look at the profile, look at what they're actually doing for you to justify that fee. I mean, if let's just say you have a 0.5% annual fee, that's only $50 for every $10,000 you invest on a yearly basis. So that's less than $5 a month that you have to pay to get access to professionals that do your investing and go through the trouble of the buys and the sells and the options and everything else you guys do, and we don't have to worry about it. So I'm always a big proponent of find the best fund that fits your needs, and the management fee should be secondary to you, is the way I look at it.
I think that makes sense, and even to go back to your point about meeting expectations, that's a big part of it. And I guess if we think of it in terms of pure beta, the expectation is that the index tracks, or the fund would track the index. In the case of buffer ETFs, the expectation is, well, if the market is down, I expect this fund, this buffer, to protect me against that loss over that time period. And that's exactly what our buffer ETFs have done. We've gone through over 400 different outcome periods, and every time the buffer has done exactly what we said it would do. And so that's a huge part of it, is that it's meeting expectations, especially when it comes to risk management in some of these volatile markets like you referred to that we've seen of late.
Yeah, absolutely. So I think that's probably a good transition to, let's turn over to the ETF we're going to talk about today is SPUT. Again, it's the Innovator, excuse me, it's the Innovator ETF Premium Income Daily PutWrite ETF. So it's a little bit of a mouthful, but can you give us a high level 30,000 foot view of what this ETF is about? And then we'll go into some of the details.
Sure. Yep. So this ETF is designed to offer basically kind of three things that fit together nicely. The first, as the name implies, it's designed to offer a meaningful rate of monthly income.
Mm-hmm.
It's also designed to offer the potential for capital appreciation, and it's meant to do it in a way that is lower volatility than the stock market. That's, I think, the simplest way to think about it. Income, capital appreciation, lower volatility.
Absolutely. So I was looking on your fact sheet, and it says that the beta is like half, so 0.51. So it's basically half of the S&P 500. Is that because of the PutWrite strategy that you guys incorporate?
Yes, the PutWrite strategy has a very low volatility, and we can get into why that's the case. But it's also a function of the fact that the fund allocates half of its assets to stocks. So that's also a big part of it, right? You're only holding half the S&P 500, so you get about a 0.5 beta from that.
Okay, that makes a lot of sense. Okay, so if I understand correct, you guys purchase the individual holdings within the S&P 500, and then you guys do an options program on top of that. So it looks like you focus on puts, but can you explain more in the details of how that is operated?
Yes. So I like to start by saying this is very similar to a covered call strategy in the sense that it's holding equities and it's selling options for income. Investors are really familiar with covered calls. I mentioned earlier there's about $110 billion in the derivative income space, and about 95% of that is in strategies that are doing some kind of covered call. So those are widely known, widely used. This is not so different. The feature that really stands out, that differentiates it, as you just mentioned, is that instead of selling calls, we are selling puts. We're selling a put every day, and the put itself, the put option, has an expiration of 1 day. Right, so we sell it at the close of 1 day, and it expires at the close of the next day.
Yeah, great. And for people who aren't very familiar with options, can you explain what a put is, just briefly?
Yeah, very simply, the buyer of a put option is given the right to sell the underlying reference asset. It could be the S&P 500, for example. They can sell the S&P 500 at a given price, right? And so they would pay money to buy that put option, and in exchange for that, they get the right to sell it at a given price by a given date. And options can go from 1 day out to multiple months or even years.
Yeah.
Here we're focused on 1 day options.
Okay, so you're setting up a put, you're selling a put. So you're looking for a buyer to buy it from you, with the understanding that they have the option but not the obligation to sell you the S&P 500 at a certain price by a certain date, which in your case is the next day.
That's right.
Based on that, you get a premium or cash up front for being the seller of that put. Now, a lot of the times the premium that you receive is based on the risk you take on the put. So can you explain what delta you use or what percentage of the portfolio you are writing these puts on?
Yes. Yeah, that's an important point about this. As option sellers, as investors who are selling options for income, we want to make sure that we keep as much of that premium that we get as possible. And so one way to do that is by selling the put with a strike price that is not likely to be breached. Maybe I can explain that a little better. The strike price on an option is the price that the seller can sell at. So, right, say we're talking about Apple stock and we want to put on Apple stock. I could say I want the right to sell Apple at $400 a share. So, right, if Apple were to fall to 300, as the put owner, I would have the right to sell it at 400. So what we are doing is selling puts on the S&P 500, and every day we are selling what's called a 5 delta put. Now, 5 delta, what that means in this context is that put is estimated to have a 5% chance of expiring in the money. What does in the money mean? It means that the S&P 500, we estimate, has a 5% chance of falling below that strike, right? And remember, if it falls below, that's when the buyer of the put would be glad for that, because that put offered protection. Whereas we don't want it to fall below the strike. And so we like the fact that it has a very, very low probability of falling below that strike. And then, the put owner would benefit from that. Another way to say that maybe is that it has a 95% chance of expiring worthless, which is exactly what we want. We want to keep all that premium and just it expires worthless.
Yeah. So when I write my own options, I usually start with puts as well, but I'm usually at a 15 or 20 delta, which means there's about a 15 or 20% chance that it's going to go against me, if you will, and I'll be obligated to fulfill the contract. But the fact that you guys are only using a 5 delta, that's very conservative. But if you do those small conservative trades daily over and over and over, that generates a lot of income throughout the year. And that's the main way you guys are providing the income to your investors, is that premium you receive by taking that very conservative options approach.
That's exactly right. And I'll expand, if I may, a little bit on puts and comparing them to calls. There's a premium in the options market for puts. And one reason for that is just investors, they really demand protection. They like protection. Maybe you've heard of the studies about how investors, right, they feel losses twice as intensely, the pain of losses. They feel it twice as intensely as they feel the satisfaction of a gain. So investors really, really like, they don't want to lose money. And so that makes put options more expensive than call options. If you take a put option and a call option with the exact same characteristics, 99% of the time, that put will have a higher price. And so as investors who are selling, we like that higher price. And so that's one differentiator from covered call strategies. Another point that is interesting is that a lot of the big banks, just from financial regulations, some of the stuff coming out of the financial crisis, to manage their risk, they have to be buyers of these puts. So that also puts upward pressure on the prices of put options, which again, we like as sellers of puts for income.
Yeah, absolutely. Selling puts is one of the main ways I generate options income. So I definitely agree. It's, you get a little bit higher premium, and you get not a tiny bit, but a little bit of downside protection before the put strike is exercised. So you're building in a little bit of protection, and you're gaining the income for selling that. So it's like a double benefit to you.
Another important point to consider about writing these puts, and specifically that aspect of the puts being 5 delta, is that every day the put is being written, sold at a new strike price. So it's constantly adjusting to changes in the market and to changes in volatility. And so what we've even seen during this most recent period is that one day the put maybe would be 2% out of the money. And then as vol rises, we'd see the put the next day be 4 or 5% out of the money, which is really a key attribute of that 5 delta adjustment. Because again, we don't want that put to expire in the money. We want it to expire out of the money and worthless, so that we can keep all that premium.
Yeah, that's actually a really good point. I'm glad you brought that up, because a lot of the covered call ETFs do monthly calls or 45-day calls, and you can't adjust based on what the market's doing. You're kind of stuck in that long period unless you roll it over. So by resetting, to your point, every single day, you can take advantage of the swings in both sides of the market. So I think that's a great point and a great benefit from your approach.
And some of the call strategies as well, they're just writing it at the same strike, right? There's no adjustment, no dynamic adjustment to what happened in the market. And so that was a key, that was a must for us as we were thinking about this product.
Yeah, another great point, because there's a lot of other ones out there that are paying out a super high yield, but to your point, they're doing it at the money. So you're either going to be capped at the current price, or you're actually going to participate in all the downside with none of the benefits, because you're riding so close to the money. So into some of the details of the fund itself, it was launched about a month and a half ago, so March 14th. As you mentioned earlier, it does pay a monthly distribution. For May, the distribution was about 19.5 cents per share, which, if you analyze that, it looks like it's around 9.5 to 9.6 a year. Is that the expected range that we're looking at going forward, or how do you guys feel that's going to look?
Yeah, this was our first full month of income, and of course, it was a very volatile month, which meant that we got a lot more for those put premiums than we would like in a more normal month. And so this is higher than we anticipate it being going forward. We expect it to be between 6 and 8% going forward is our estimated range. And of course, it will at times go outside that, but that's generally the ballpark of what we anticipate.
Okay. A little bit more about the fund. The top holdings, it looks like you have quite a significant holding in Treasury bills or T-bills. It looks like you're using ELNs, so I'd love for you to explain that briefly. And then you hold the underlying assets of the S&P 500, so the ones we all are familiar with: Apple, Microsoft, Nvidia, Google, Facebook, all the ones that you would normally expect in the S&P 500, but it's only a portion of the portfolio, and then you're using the rest of the portfolio to write the puts. And I guess you also get the interest from the T-bills as well while you're holding that cash. Is that an accurate depiction?
That's right.
Okay.
That's right. Yep. 50%, again, as we mentioned earlier, is in the equities. Then we have a 30%, approximately 30% allocation to T-bills, short-term T-bills. And then the remainder is allocated to that ELN, an equity-linked note that you mentioned a minute ago. And that is where the majority of the put writing strategy is coming from. It's about 75% of the put writing income comes from that ELN. And then also inside the fund is selling a put every day as well to make up the remaining 25%. So puts are being written against 100% of the portfolio, about 75% coming from the ELN, 25% inside the fund.
Yeah, that actually makes me even more excited about this fund, because you are diversifying your income sources and your exposures. So you're not only relying on the underlying holdings or the S&P 500 index. You have a mix. So you have, one, the dividends from the underlying holdings; two, the interest from the T-bills; and then the third thing is the premiums or the income you receive for your options between the ELN and the individual puts. So that's a very good diversification in my mind, at least. Another thing people are really interested in when it comes to these derivative-based ETFs, cover calls, and put strategies is the tax treatment. And so a lot of the times the distributions that are produced are either current income, return of capital, or some kind of long-term or gain. Can you give us a brief estimate of what the breakdown might be, or we should expect from this fund?
We expect that most of this will be ordinary income. There could be some return of capital as well, but out of the gate, we're anticipating a good chunk of it to be just ordinary income.
Way to really know until the end of the calendar year when you get your statement what the final outcome is going to be. But as long as you know going in that the majority is going to be expected to be ordinary income, you have to take that into consideration. Obviously, if you have an IRA or Roth IRA, you don't have to worry about the taxes now. But if you do have a taxable brokerage, it will vary what your tax bill is at the end of the year. It may not be the long-term capital gains rate that we get on normal dividends. So just keep that in mind when you're deciding on having this as one of your positions or not.
That's right. That's right. Yeah. That's why we're positioning it that way, to set expectations so that investors can manage that.
Got it. Okay. And as I mentioned at the beginning, the majority of ETF companies are doing cover call related ETFs. What was it about the put strategy that was so appealing? Because you don't see a lot of those out there.
Mm-hmm. Yeah. In looking at that space, we did want to bring something that was a little differentiated. And one of the challenges that covered call funds face is that they're selling that call usually kind of at the current market level, or maybe a little bit above, with the strike price. And so one of the consequences of that is that the underlying equities effectively get capped out, right? Their upside potential is limited by virtue of selling that call. What this does is the selling the put, it kind of works alongside your equities. It doesn't cap that upside potential, that capital appreciation potential. So we wanted to bring something that offered both meaningful income, as I said at the beginning, but also meaningful capital appreciation potential. And we think we've captured that with this fund.
Yeah, it looks great. I mean, I know it's only been a month and a half, but so far so good. I really like what it's having to offer. If someone wants to get more information about this fund or any of your other funds, what's the easiest way to find out?
Just visit our website, innovatoretfs.com would be the best place to start. All of our contact information is there as well if they want to call in and discuss it in greater detail.
Perfect. And are you guys on any kind of social media?
We are on LinkedIn and Twitter as well. You can follow us there.
Awesome. Everyone, I'll put the tags in the video, but everyone go check them out. Joe, appreciate your time. Appreciate you talking through SPUT with us. I think it's a great fund. Everyone should definitely check it out. Make sure it fits your risk tolerance. It's not a recommendation. Make sure you do your own research. But Joe, really appreciate your time and giving us the information about this very innovative new ETF that you guys have.
Thank you, Jeremy. Really appreciate it. Good to be here.
Thank you. Appreciate it as well. Have a good one.